So look, you probably don't need me to tell you that last year was pretty damn tough in the stock market. It's actually been the worst performing year in over 14 years, taking us right the way back to the financial crisis of 2008, with the S&P 500 closing down 20% for 2022. So whilst many of our investment portfolios got absolutely wrecked during last year, what's the outlook for 2023? Will it be more of the same, or will we see a turnaround in market performance, which I'm sure we'd all welcome with open arms? Well, I've been reading some papers written by the experts, so to speak, from some major investment companies as well as some major investment banks too, on what they predict is going to happen during 2023. So be sure to stick around because it certainly makes for interesting reading. But before I dig into all of the details, all I ask guys is that you just drop a like on this video. It really helps out the channel as well. Whilst you're over here, be sure to hit the subscribe button too. With that being said, let's begin. There are 475 million search results for a stock market crash right now on Google. That compares to the 82 million search results for a 2023 bull market. If market headlines are a depiction for the current sentiment of the stock market, then I think it probably goes without saying that we're certainly swinging on the pessimistic side of the pendulum of the collective market mind. But the question is, could we really see 2 consecutive years of negative stock market performance? Because let's face it, 1 year in the negative has certainly been bad enough already.
I've got nothing left.
Well, it's only happened 4 times since 1928, so the odds certainly suggest not. But if stocks do fail to turn around, according to historical data which has been compiled by Bloomberg, second-year slides have always been deeper than the first, with the average decline clocking in at 24%. So I guess that leaves us with 2 possible scenarios. The first scenario being a steady stock market rebound where market prices gradually gain positive momentum throughout the course of 2023, or on the other hand, market prices continue to decline, worse than what we saw last year. So with that all in mind, what are the experts saying about the 2023 stock market outlook? Well, Blackrock, which is one of the largest investment management companies on the planet with over $10 trillion in assets under management, have just released their 2023 global outlook, with their headline being a new investment playbook. The first thing that springs to my mind, will the strategies of old still be relevant for the future market conditions? Well, let me summarize some of the key points from the report. Firstly, let's discuss the new regime. Now, the new regime is all about the sustained inflationary issues that we're seeing across the global economy, because it's not just a US problem or a UK problem. In actual fact, inflation across the board is affecting countries all across the globe. When you look at a list of the G20 countries as an example, most of them are seeing inflation rates well over 5%, which compares to about the 2% target inflation rate, which is the widely accepted target rate that central banks have. Now, BlackRock believes the only way to actually manage those high inflation rates is to somewhat manufacture a deep recession. In essence, what BlackRock are forecasting is that GDP would need to reduce significantly back down to the green dotted line, which you can see on screen, which would require the Federal Reserve to deal a significant blow to the economy. And as of right now, that very much feels like the path that we're on. We've got the Fed aggressively hiking interest rates, which is actually having a little bit of a positive effect on the US inflation rate. But we've still got quite a long way to go before those inflation rates actually become more stable. So a crushed economy in 2023 is looking like a probable outcome, leading to a deep recession on a global spectrum. So with that in mind, how does that impact our own investment portfolios? Well, we all know that equity markets are forward-looking. They look to price in the future, with big investment management companies actually looking to forecast what's going to happen at some point in the future, and then adjusting and amending their strategies in order to mitigate their downside risk. And this is what's also referred to as being risk off on assets. But how much of this economic damage is already priced into the stock market? Well, let's discuss one of the key themes that BlackRock actually wrote about in their report, which is equity valuations. BlackRock's opening line in this section is, navigating markets in 2023 will require more frequent portfolio changes. And that's based on their assessment of 2 key things. Firstly, the market risk sentiment, and secondly, their view of economic damage being reflected in market pricing. And BlackRock's current view of equity markets right now is certainly risk off, but with the damage not being priced in. Now, I think it's probably obvious to say that we're risk off amongst assets, with equity markets absolutely plummeting in the past 12 months. But I think probably what most of you guys wanted to hear, that the economic damage in 2023 had already been priced into the current conditions of the stock market. But according to BlackRock, we're just not quite there yet, stating, we find that earnings expectations don't yet price in even a mild recession. And for that reason, we stay underweight on equities on a tactical horizon for now. However, on the flip side, on a slightly more positive note, I guess you could say, they did go on to write, "We stand ready to turn more positive as valuations get closer to reflecting the economic damage." Where the absolute critical number sits in terms of the earnings per shares being generated, BlackRock didn't go on to cover. But despite this, BlackRock did give a little bit of an insight as to where they may potentially be looking to position some of their equity investments over the course of the next 6 to 12 months, stating that they're looking to lean into sectoral opportunities from structural transitions. So here are some of the opportunities that they're looking at right now based on appealing market valuations, along with resilient cash flow in perhaps more tougher economic times to come. The first opportunity being in the healthcare sector. The core reason behind being optimistic in the healthcare space is thanks to an aging population. And here are a few of the stats behind that. By 2030, 1 in 6 people in the world will be aged 60 years or over, which for context, the share of people within that over 60s population will actually go from 1 billion people in 2020 to 1.4 billion people by 2030. However, by 2050, that number will nearly double again to 2.1 billion people. So with those stats in mind, with people living longer and just an aging population more broadly, there is going to be a growing demand on the healthcare sector on a global scale. And with increased demand comes growing financials, and with growing financials, potentially there will be a higher return on investment available to shareholders. The second key opportunity is in the energy sector. Warren Buffett pulled off another blinder within the energy space most recently with his investment in Chevron, netting off a reported $13 billion, which is certainly being helped on by the Russia and Ukraine crisis, causing a mass shortage of energy and a spike in energy prices on the whole, which has actually resulted in energy companies more broadly showing record profits across the board, and the energy sector actually being the top performing sector for the year in terms of return on investment. Now, according to BlackRock, the energy sector on the whole still remains a buying opportunity, despite earnings easing from historically inflated levels. Nonetheless, they still believe that they'll hold up amid tight energy supply. And with global energy consumption forecasted to increase in 2023 by 1.3%, despite the risk of an economic downturn and potential recessions, there still very much appears on the whole to be good buying opportunities within the energy sector space, which traditionally is traded at very good valuations. The third opportunity is in the financial sector. This is possibly one of the best times to actually hold bank stocks within an investment portfolio since before probably the financial crisis of 2008. As BlackRock states in their report, higher interest rates bode well for bank profitability, and that's certainly true. Banks have certainly struggled to make a lot of money in the past decade and a half or so, due to historically low interest rates. But now, things are obviously changing. Interest rates are now on the increase, and banks must be rubbing their hands at the thought of potentially being able to earn a hell of a lot more money. However, with that, do bear in mind certainly comes a balancing act due to these kind of unique economic circumstances that we find ourselves in. Whilst banks certainly make more money as a result of interest rates going up, and me and you as a consumers essentially paying more on the debt in which we have. However, on the flip side, there will also be some losses from loan defaults from individuals and companies that can no longer afford to pay back the debt which they acquired perhaps at a slightly lower interest rate, thanks to the fact that interest rates are now moving higher. So certainly a bit of a balancing act to play here, and I'd certainly be looking at the kind of banks that have very resilient balance sheets in order to give me a bit of an indication on how stable they are as a company if there were to be a significant uptick in loan defaults. But nonetheless, on the whole, BlackRock very much seem optimistic. So they are potentially 3 sectoral opportunities throughout 2023. But what about equity markets on the whole? Well, from 14 major banks all around the world, only 2 of those banks actually believe that the S&P 500 will continue to decline in value throughout 2023, with the other 12 banks believing that market prices will go higher. But don't get too excited because the forecasted returns aren't necessarily all too special. Based on today's current market price of the S&P 500 trading at 3,839 points, from the 12 banks that are bullish, the average price forecast is 4,095 points, which would be the equivalent to a 6.6% return in 2023. With the 2 banks that are actually bearish on the market for next year, actually forecasting an average price of 3,737 points, which is the equivalent to 2.65% worth of downside. So I think if there's anything to read from that, there's not too much in the way of extremes in either direction, which I guess you could say is probably one of the jobs of some of these major banks, is to keep people sane and keep people stable in these very tough market conditions. But nonetheless, I'd be very happy with the 6.6% return during 2023 if those kinds of returns are on the cards throughout this year. But what do you guys think we'll see in terms of stock market returns during next year? Well, be sure to let me know down in the comment section below. Now, despite what the stock market does throughout 2023, I actually made a video which you can click on here about why investing now could just be the opportunity of a lifetime. So be sure to click on that video next, and I'll see you over in the next one.